Hey everyone, and welcome back to another Q&A live stream here today. If you're in here live, if you could just let me know if the video and audio are working well. If it's too quiet, let me know. If the video quality is bad, let me know as well. But if everything else is working, then also let me know. But welcome in everyone live, and also, firstly, I want to say welcome in to some of the new students who joined this week. And basically, just a bit of a refresher on what we're doing here in these Q&A live streams is that basically, a couple of days before I do the live stream, so this was yesterday, I make a post in the Facebook group, and I'm asking you to either, put it in your calendar to join the live stream live, or you can ask a question if you can't make it live, and you want me to still answer a question. So basically, if you're new to Learn by Example here, and you can't make the live stream, or even if you can make the live stream, but you just want to ask your question ahead of time, you can by posting your question here. And basically, I start by answering all of these questions first, and then I go one by one and answer all of the questions live that get asked. So if you're in here live, you can ask a question, and I'll be answering questions until there are no more questions. So it looks like everything's working. Hey Paul, thanks for letting me know that everything's working. But other than that, I think we'll probably just get into this because we've got a couple of questions here to talk about. Alright, so we'll start with Matt's question here. Hey Hamish, wondering if you've looked into and have any recent thoughts on Boeing. Obviously a ton of changes in the last couple of years for them, and curious on your thoughts on the long-term prospects. Yeah, so Boeing isn't a company that I've looked into particularly thoroughly, and the reason why that I kind of stayed away from it, even though I think that it clearly has a very powerful brand, is just because it's a business that's very capital intensive, and they manage that by having a lot of debt. And that kind of business is just one that I'm not particularly interested in investing in. I can pull up their numbers, I guess, and we can have a quick look. I haven't looked at them in a long time, but I mean, in terms of the Boeing brand and the industry that they sit in, it's Boeing and Airbus, and Boeing beats out Airbus in terms of sales and that sort of thing. So it's really a duopoly, and they have such a powerful brand that I have really no doubt that they will be able to, I have no doubt that the brand will continue to have power over the very long term. But just having a strong brand is not enough, because even businesses with really strong brands get into financial trouble. And if a business goes bankrupt that has a really powerful brand, the brand will live on. So there will be some new owners that come in and buy the what am I thinking of? The non-physical assets, the intangible assets is the word I'm thinking of. They'll come in and buy the intangible assets, the branding and all of that stuff. And the Boeing brand will live on. It's just that if you were a shareholder in that business, you will no longer be a shareholder in that company. You will lose your investment. So I think the brand is going to be around for a very, very long time. But in terms of the business specifically, in order for me to feel confident that as a shareholder I will be protected, it needs to be a business that has very low levels of debt, lots of equity, lots of cash around, lots of short-term assets around, very cash flow positive, high returns on investments. And Boeing just isn't that company. Their equity is negative. They have $18 billion in long-term debt. They have a fair bit of cash, which is good, but yeah, it's just not a business that I'm particularly curious about looking into in depth. And yeah, they actually lost quite a lot of money. What did they lost quite a lot of money in 2019. I mean, I haven't looked into it thoroughly enough, so I can't really draw an opinion, but basically I didn't look into it further because it had too much debt. But that's not to say that I wouldn't look at it in the future, or maybe there's changes happen in the business. I honestly don't know, and I love the brand, so I think we'll just have to kind of leave that one there for now. Andrew says, hey Hamish, you have done a stock analysis on PepsiCo, National Beverage Corporation, and Monster. I was wondering if you were planning on doing an analysis on Coca-Cola. After all, this is one of Warren's all-time favorites. Yeah, so I wasn't planning on doing it, and simply because they're in the worst financial position out of all of those companies that were just mentioned. PepsiCo is pretty bad too, but I did end up having a look at them. So maybe I will look at Coca-Cola, but yeah, I mean, this is what happens with businesses that are really successful, is that they get to a point where they can't grow anymore, and they're still a great business. Their brand is still powerful. I still think it's a great company, but they are just not getting the returns that they can't continue to invest money and generate high returns on capital. There's just no more room for them to grow. So what these companies do is they slowly change their capital structure from being very heavy equity and small amounts of debt to using more debt in order to boost shareholder returns. So that's a typical transformation for a business that's in its mature stage, and the Coca-Cola company is in that stage. And going through that stage where the business takes on more debt slowly and delivers more capital to shareholders is good if you were already a shareholder for 10 years or for 15 years, and the company and the management team's kind of squeezing out the last bit of profit last bit of growth out of the company before it stops growing or starts to decline. So as a really old shareholder like Warren Buffett, that's fine. That's good. You want them to keep squeezing until there's no more profit to produce anymore. But as an investor today, like myself, for example, looking to get into a company, I want to get into a company before they are having to squeeze profits. I want to get into a company that still has tons and tons of growth opportunities in front of it, or into a company that's at Coca-Cola's stage, but is very, very cheap. And therefore, they don't need to grow a lot in order to deliver good returns. But yeah, I mean, you can see that over the past, 10 years here, their debt position has grown from $5 billion to $27 billion. So they've just been in a process of gaining more debt so that they can use that debt to fund their dividends and fund their share repurchases. That's basically what these businesses do when they get to that late stage in their life. And if you compare that to something like National Beverage Corporation, so if we compare that to National Beverage Corporation, they don't have any long-term debt, and they're able to grow really quickly because they're a smaller company. They may have some advantages, and as a result, they're able to grow without having to use debt to deliver higher returns to shareholders. But if this company gets big enough and it gets to the point where it can no longer grow, management's going to look at ways to boost those shareholder returns. So I don't think I'll look into Coca-Cola, just because I mean, what I'm gonna say on it's pretty straightforward. It's that it clearly has a huge branding advantage, but it's a mature business and probably doesn't have the ability to deliver the returns that we're looking for when we're trying to make a 15% return. And there's not a whole lot more to say about it. So I mean, I could, but it would probably, it wouldn't be my first choice for a business that I want to analyze, because I do want to be looking at businesses and spending my time looking at companies that I genuinely think have a chance of being in my portfolio, and Coca-Cola just isn't one of those companies. It might be a company that has, I mean, I could see it being a company that has relatively low risk of losing you money, but and a decent chance of delivering you a 5% return or a 6% return over the next 10 years. But can I see it having a decent chance of delivering a 15 to 20% return? No. And I don't see it getting anywhere near that. And as a result, it's not sort of worth doing further analysis. So that's kind of my thoughts on that. I have a similar opinion about PepsiCo, but I ended up doing PepsiCo. I don't know. I just decided to do it, but yeah, in terms of Coca-Cola, I probably won't. Okay, so this question comes from, actually, before I answer this really long question from Luke, I'll answer some live ones. So Sumit says, good morning. Which company are you reviewing for the next report? I'm still doing some research on a few, sort of early research on a couple of different companies. So I won't announce that today, which company that I'm going to be doing the full analysis on, just because I haven't really decided yet. But you'll find that out later in the week. Usually I announce it on, I'll announce it next week on the Q&A live stream that's just a couple of days before the report is released, so I'll announce it then. But at this point, there's a few that I could be doing it on, so I'm not sure. The next question here is, growth investing has beaten value investing over the last 2 decades. There is a wave of investors saying we are at the age of innovation where the big winners will be growth stocks. Look, I don't like to categorize businesses as growth and value, and I'll tell you why. Because when I'm looking at a value investment, I'm not necessarily avoiding companies that have huge growth potential. When I'm talking about value, all I mean is that I'm figuring out what I can get back from the business so I know what to pay. It's my view of value investing is kind of like, can this investment confidently make me a return? Can I get to that? Can I come up with a calculation that makes me confident to believe that I can make at least a 15% return? And that kind of splits businesses into 2 piles. Businesses that have the characteristics of a stable, consistent business that I can make future projections, and businesses on the other side that are too new, they're in a new industry, or there's some other characteristic about it that means that I cannot make future projections about where the company will be accurate projections. And for example, I think Facebook's clearly a growth company, but I think that I can make a reasonable estimation of where that company will be in the future, because the reason why they're growing so fast is more of the fact that they're in an industry that is growing quickly, not the fact that they're a tiny company in an industry and they're just, exploding with growth. They're a huge company. They're the second biggest company in the digital advertising space, and they're in a duopoly with Google. It's just those two companies. Those two companies basically own that market, but they're growing really fast because there's always new revenue coming in. There's tons and tons of businesses moving money from TV and newspaper advertisements onto the internet. And as a result, they're growing really quickly. So that's the kind of business that is growing quickly. It's most people would classify it as a growth company, but I think you can make reasonable estimations about where they'll be in the future. And I compare that to something like, what's a company? Let's say something like Tesla, where it's a growth company, clearly, but they're barely profitable, and it's very hard to see where that company will be and how much cash they will produce in the future, because they're still a relatively small player in the overall auto industry, and they've only been around for, a handful of years, and they've only been profitable for a couple of quarters. So I don't like to split businesses into growth and value, because I mean, a lot of the time I'm looking for businesses with value in them so that I can buy them cheap, but they've also got some growth potential in front of them. And then, I mean, in terms of growth outperforming value, yeah, I mean, that has been the case. And I mean, especially over the past 10 years, just because the market has just been on such a tear, it has been beneficial to ride companies that have huge growth expectations in front of them. But historically, value has done way better than growth in terms of buying businesses with a high valuation attached to them, a high multiple on their earnings. Historically, value has done very well, and there has been periods where growth has done better than value, but that usually kind of comes back to earth, because ultimately you can pay up, you can pay up as much as you want for a business, but if it doesn't bring in the cash that it can then deliver to you in dividends and share repurchases, if it does not bring that cash in, then there's no value in that business. And the market might not recognize that, for a very long time, for 3, 4, 5 years, but the market will eventually recognize that. And that's historically what's happened. There was tons of growth companies around 2000 when everyone was saying this is the new age. This is, you can't do value investing anymore. You have to invest in these new tech internet companies that have, ridiculous valuations. And then a couple of years went by, and they were generating huge returns, and then investors realized these companies don't make anything. There's no cash. So I'm completely speculating on someone else paying more for this business rather than buying a business because it produces cash that can be tangibly delivered to me in dividends. And that's the kinds of businesses that I look for. Businesses that actually produce cash flow that it might be in the company, the cash, it might stay reinvested in the business, but it's there so that at some point it has the potential to be physically delivered to me in my bank account. So that's kind of my thoughts on that. I hope that kind of answers your question. If you have follow-up questions, I'd love to continue that discussion if you're interested. But I hope I answered your question. I don't really, ultimately, my summary for that is I don't really like to categorize businesses like that. And in my value portfolio, I have businesses that are really classic value businesses where they're slow growers, but I also have fast growing businesses like a Facebook, for example, or even a Texas Roadhouse is growing quite quickly. And they might be considered growth companies, but in my view, I think they're more value investments because I can reasonably come up with an estimation of the cash flows. And that's where my definition sort of comes from. And that's the exact same answer that Warren Buffett will tell you. At least if you look at Warren Buffett's stuff over the past couple of decades, he more recently, over the past, I say more recently, but over the past few decades, he sort of pivoted towards more businesses that have the potential to grow, that have growth available for them. And he believes that that is still a part of value. You want a business that you can predict future cash flows reasonably, get it at a good deal, and also the potential for growth there. All right, so let's answer this question from Luke. So, hey Hamish, why do you choose individual stocks instead of index funds? I've always believed individual stock picking is the way to go, but recently I've been second guessing my decision. It seems pretty logical on the outset that with the time spent researching, you should be able to make better than average returns, but there is a statistic that states 99% of investors do not beat the market. I don't seem to understand why this is the case. Personally, I struggle to see this as a credible argument for buying only index funds because I think that this has been measured over the past 20 years, which includes the global financial crisis, and also because people just blindly assume they can correlate past average returns into the future, which has been proven to be a notoriously bad indication of future returns. The other reason I suspect this is not the case is because fund managers require a really low risk appetite for their clients and have quarter-to-quarter accountability, which makes it really difficult to produce above average returns. If someone put to you a strategy of only investing in index funds because nearly all investors don't beat the market, what is your argument? Yeah, so, I mean, there's a couple of things to say here. The first is that for most people, index fund investing is the way to go. And the reason why is because most people cannot follow a strategy. They can't follow the right strategy for starters, but then even if they have the right strategy, they can't follow it consistently. They're always making emotional decisions, selling when stuff is going down because they're panicking, or, listening to the news and thinking there's a crash coming, so they're selling everything, even though rationally that makes no sense because ultimately we have no idea if the market's going to crash. So most people are better off not thinking when it comes to investing. And the best way to not think when it comes to investing has been historically to buy index funds. Now, those index funds, you're absolutely right that there's no reason to say that just because historically index funds have returned 10% per year or whatever, that they will in the future. But if you're buying a diversified basket of companies in the US or Australia, I would say that you have a very, very high chance of not losing money. So it's probably the safest option for most people who want to be hands-off. And then whatever the return is, it's going to be better than a savings account. It's going to be better than a lot of other types of investments. So it makes a lot of sense for most people to do that. Now, in terms of, I want to talk about this statistic of 99% of people not outperforming the market, because I agree with you that it's not a credible argument, and this is why. Take for example, if you were to buy a lottery ticket, okay? So if you buy a lottery ticket, you have a certain percentage chance of winning. Maybe it's 1 in 50 million or something. It's pretty low. I think it's maybe 1 in 10 million or something like that. But the reason why that statistic is accurate is because everyone who is entering into that lottery system is doing the exact same thing, okay? They have one lottery ticket. They are picking the 10 numbers randomly, and everyone has an equal chance of their numbers being selected, taking out people buying multiple tickets. But basically, everyone is doing the same thing. So the probability is real. It's a real chance. It's like if you roll a dice, you've got a 1 in 6 chance of picking the number that you think is going to come up. But the same thing doesn't really apply to something like investing, because everyone isn't doing the same thing. We're not all picking stocks blindly. Most of us are trying to everyone's trying to outperform the market, I would presume, but everyone has different ways that they go about trying to do that. Some people speculate on small cap, micro cap businesses. Some people just buy into businesses that have big brand names and they don't look at the valuation. Some people do analysis, but they don't look at management, so they don't avoid making bad investments in managements with CEOs who are, trying to make a profit off being the CEO rather than generating returns for shareholders. So everyone is doing different things, and included in all the individuals is, of course, the fund managers, which make up most of the market. And you're right, those fund managers are they're trying to make returns on a quarterly basis. And there's a famous saying that, actually, I don't know how the saying goes, but it basically, the saying means that you can, in order to perform over the long term, often you have to sacrifice performing all the time. So whenever a fund manager is trying to make a return every single quarter, they often sacrifice the best long-term return. And we've seen that play out. I mean, the best time to invest in great businesses is when their stock prices are going down. But often, a great business's stock will go down for 6 months or 3 months. And a fund manager can't hold that business. Because if that stock goes down for another 3 months, which, let's say it's been falling for a couple of months, it might be the best time to buy that business. But if they buy heavy into that business and it falls for the next 3 months, their quarterly returns are stuffed. Their clients pull money out of the fund, because most of their clients are average Joe people who don't understand that you can't make a return every quarter and expect to outperform the market over the long term. So they really struggle to outperform over the long term. And basically, I think, and this is just an opinion, I don't know if this is true, I don't think anyone knows if this is true, but I think that if you're following principles that have been laid out and proven to work over time, which is analyzing the underlying business, making sure you're investing in strong businesses and looking at their cash flows, I think if you took a pool of the people who were doing really thorough analysis, following those strategies, those principles laid out by Warren Buffett, for example, my guess is that the percentage of people who outperform the market is substantially higher than 1%. I don't know what it is. It could be 4%, it could be 10%, but I would say it would be substantially higher, because there are so many people in that 99% that are individuals who have no idea what they're doing, individuals who are gambling, or fund managers who are not really trying to outperform the market. They're really not. They're trying to outperform in a quarter and try to make a positive quarterly return every single quarter. So that's my opinion on that. I think that your actions in the market, the way that you go about analysis, the length of your analysis, increases the percentage chance that you will be successful. And that is completely different to a completely random game like rolling a dice or the lottery, where there's nothing you can do. I mean, with the lottery, you could buy more tickets. But let's say you can only have one ticket. If you can only have one ticket, there's nothing you can do to increase the odds of you winning, because there's no room for that. And I think the same thing applies for business owners. You see a statistic going around that 99% of businesses don't last beyond 5 years. And again, that statistic doesn't really serve any purpose except for giving you an overview of everyone. But everyone who are running businesses are doing different things, and a lot of people just give up early, which is why they don't last over 5 years. So it's not as if everyone is doing the same thing, and it's an activity where there are things that you can do to increase your odds. And that's why I don't think that statistic kind of makes sense. But with all of that said, I know I've spent a long time on this question, but with all of that said, only people who are really interested in businesses and are really willing to do the thorough analysis, only those people will be able to raise their chance of outperforming the market enough that it's worth doing. And that's important, because a lot of people want to outperform the market, but most people don't have the discipline to sit down and thoroughly analyze a business and make rational, logical decisions in that business. And as a result, most people will probably be better off picking index funds. And I have a combination of both because I recognize that there's a decent chance that, I don't outperform the market, let's say over a 10-year period. I've done so far, but again, that's kind of it's a small sample size. It's only 3 years. So over a 10-year period, will I outperform? I don't know. And as a result, I still have that index fund proportion of my portfolio that I know will give me the market average. And that's kind of how I operate with that. Okay, we've got a live question here. I'll answer this first. My only other argument for growth stocks would be that the market, partly due to the Fed, is overvalued. So traditional valuation doesn't matter as much. I mean, if you're going to throw out valuation, then you're just speculating. You're speculating that someone will pay more. You no longer care about what the actual cash being produced by the business is, because only real cash produced by the business, only real profits can be paid out as a dividend and put into your account. So in terms of real returns, that cash returns that can come to you, you have to care about valuation. And it doesn't matter if the market is overvalued. You have to care about valuation and you have to be strict. You could speculate that someone's going to pay more, but I have no idea how to do that. And my view of that is that it's gambling. So you also say here that that coupled with Buffett underperforming the market over the last 15 years and your video underneath about Seth Klarman buying Google and Facebook causing me to rethink matters in the midterm. Yeah, I've got a couple of things to say on that. One, I think Buffett is underperforming because he's too big now. And that's kind of the nature of when you get to that size, the opportunities available to you are so small. So I don't attribute, I think if Buffett had $1 million or Buffett had $10 million, he'd still be making 20, 30% returns. I think there's no doubt about that at all. And he said that himself, that he could make 50% per year if he was working with $1 million. So, not to argue with you, Hamish, but what is wrong with taking a 3 to 5 year growth profit while the market is... Yeah, it's just that you can't be confident that I don't know where the market will be in 3 years. It could be higher or lower. Whereas in 10 years, I know that it will be higher. And if I'm looking at strong businesses, then in 3 years, we could be back. This pandemic could still be going. We could still be in a depression. I don't know what's going to happen in 3 years. So when I'm looking 3 years out, I just have less confidence. It doesn't mean you can't make an investment and make a profit during that period. You certainly can. And there's been many periods where that's been the case. But I just like the mindset I have when I invest in a business is I'm thinking 10 years out, because I know that if it's a strong business that meets our standards, then it's going to be bigger in 10 years. And I know it will be. But in 3 to 5, it may or may not be. But that certainly a lot of people look over a 5-year period. And 5 years is usually enough. I just like, the 5 to 10 year gap, because no recessions have gone for more than 5 years. So after that period, there's a very, very good chance the business is back up and running, the economy is back up and running, and it's strong, and the business and the stock price may or may not reflect that. So, yeah, that's kind of what I was saying on that. What was I saying on the other thing? Yeah, so I think Buffett underperforms basically because, this is just my view, but I think it's because he's managing too much money. And Seth Klarman buying Google and Facebook is exactly in line with my rationale behind what is a value investment. I think that those businesses can be value investments. If you can come up with a reasonable model of where those profits will be in 5 years or in 10 years, then you can invest in those companies and you can get a good deal on those businesses. Just because they're growth doesn't mean you can't buy them as value investments. That's the way I look at it, at least. I think that, certainly if this sort of recession goes on for, a few more quarters, we will definitely see that, we'll definitely see the chance of some classic value businesses, have the chance of, as a group outperforming growth. But that's kind of not been the case at the moment. A lot of the growth companies have just kind of continued to tear upwards. So, we'll see how it plays out, but ultimately businesses and their stock prices, they pull towards how profitable they are. So if we're looking at businesses and we can find out that we're confident that they will be more profitable in the future. That's basically the whole thing is, will they be more profitable? And can I be confident that they will be? Some growth businesses, I can be confident they'll be more profitable. A Google and a Facebook fit into that category. There's other businesses that are high growth that I cannot be confident will be more profitable in the future because maybe they have too much debt or they're not profitable yet. So we don't know if they can get to that stage. So, yeah, that's kind of how I think about that. If you have any other thoughts, I'd love to keep this discussion going if you're interested. If you have anything more to say, I really encourage sort of critical debate. I don't take any criticism to heart, and there's certainly things that I believe that may be wrong, and I'm always open to hearing other opinions and learning more and finding out what the actual truth is about certain things. So I really enjoy these discussions, is what I'm saying. So the last question we had here, so if there's no more live questions, so if you have a question, go ahead and ask it now live because it'll take a little while to come through to me. But after this question from Andrew, I'll answer any remaining questions that are in here live. And then other than that, we'll wrap up for today. So I'll answer Andrew's question, and it's probably going to be a fairly quick one. Hey Hamish, can you tell us about what to look out for when analyzing multi-symbol companies such as Alphabet, Lena, and Berkshire? Where do you find ratios? How do you plug them into the calculations in your spreadsheet? Yeah, so there's really not too much difference between analyzing a business that has multiple classes of stock versus one that just has a single class. In terms of the numbers, I mean, sales doesn't get impacted by it. It's the reason why we look at the whole business. It makes it a little bit easier if we just look at the whole business and then later we break it down into their different classes. So sales isn't impacted. Earnings per share, earnings per share will be impacted, but if you're getting these numbers from the financial statements, then, the number of shares will be in there. So basically, let's take Google, for example. Google has, they have two public classes of shares, A and C. And if you look at their earnings per share, they combine the A and C shares together and then divide the net profit by all of those shares because each of those shares has an equal amount of ownership, an equal percentage ownership in the business. So they split the total net profit by all of the different shares, even though they're in different classes. So that's kind of how that works, but that's done for you in the financial statements. So you don't really need to do anything different there. Free cash flow we look at as a whole business, cash flow for owners, we look at for a whole business. Equity we look at for the whole business. The only real thing you need to think about is when it comes to the discounted cash flow, you need to make sure that you are dividing the buy price for the whole business by the right number of shares. So when you're doing Google, for example, the automatic spreadsheet that calculates buy price per share in my spreadsheet, it doesn't calculate it right for Google. So you need to do it yourself, basically. Or the easiest thing you can do is whenever you're dealing with multiple classed shares, take the buy price for the whole business and compare that to the market capitalization instead of comparing the buy price per share to the stock price per share, if that makes sense. So basically, you're looking for the market cap to be below a certain price before you invest. It has to be below the buy price for the whole business. That's a quick, easy way to avoid making a mistake with the per share price. But there's really nothing too different that you have to do. And if there's anything that I'm forgetting, then feel free to just send me an email and or post in the group, and I'll be happy to show you how to deal with that with a company that has multiple classes like Alphabet. As Sumit says here, as a follow-up on growth versus value discussion, what would your strategy be on trying to identify future Google, Facebook, Amazon? Yeah, so I can't talk to Amazon, but and I can't really talk to Google. I can talk to Google a little bit, but Facebook's probably the easiest one I can tackle here. There's really, because most of their revenue is advertising at the moment, there's only a few things that impact that revenue. And the main thing that we need to think about is how many users do they have on the platform and how much revenue can they generate per user. And that revenue per use, so the revenue, the number of users on the platform is pretty stagnant. It's probably going to run out of growth pretty soon because it's pretty big. But the revenue per user, that's basically dictated by the demand for advertising, and there's been a consistent trend of that increasing. So you can play around with the numbers. You can say, okay, well, what if the revenue per user doubled? What if businesses were paying twice as much to advertise in front of users? Or if the engagement of those users went up, if people were using the content more, so they're seeing more advertisements. I mean, there's a few factors that I can work with where I can come to a reasonable place of where that business can grow in the future. What's, not necessarily what's accurate, but what's a conservative number that I think they can definitely hit. And that's kind of how I work with those companies. But if you're working with a company that's not profitable yet, they've never made money, and the growth in the industry is all over the place, then it's going to be very hard to make a prediction, and I stay away from those businesses. I know you did a presentation on Facebook. I would be interested to know what you think of it now and why it's a value stock. Yeah, well, the fact that it's a value stock it just comes down to the fact that I think you can buy it at a price where I can be confident that I'm going to make a certain return. So, for example, I think 15% growth out of Facebook is fairly reasonable over the next 10 years. It's a high number, but I don't think it's crazy. And the reason why is you could easily see a doubling in the revenue per user, the revenue generated per user. You could probably see it quadrupling 4 times in that number alone. That could quadruple their revenue. I'm guessing their margins will improve when they're generating more revenue because it's a pretty low capital intensive business, and over time their return on invested capital has continued to improve. So I could definitely see at least 10% growth in just revenue, just advertisers willing to pay more, because the cost of, I can't remember the specific numbers, but the cost to advertise on Facebook is so much cheaper than TV advertisements. And there's still so much ads that are being shown on TV. And if some of that comes over, those people coming over from TV will be willing to pay as much as they did on TV as they will online, because they've been paying that much. So I can imagine a time in the future where those ad rates continue to go up and up and up until they get to a point where it's no longer a better deal than a TV advertisement. So I can see quite a lot of room for increases in prices for ads. You couple that with some growth in payments. I think they'll have a good crack at growing in payments. And I mentioned in the video that I posted about Seth Klarman that I'm just confident because the management team has such a terrific record of making good investments. That's basically where my confidence comes from, that they can grow in this new industry. And I mean, I run those numbers and I can see, okay, is 15%, something reasonable that they can get to? I think yes. And then I just apply a 50% margin of safety to my valuation. And then I'm really confident that they can make it, because now they don't even need to get 15% growth per year. That's if they hit 15% per year growth, that's going to be my, up near the 20% mark of a return. Whereas if they underperform that a little bit, I still might make a decent return. And all of that aside doesn't even include the fact that they have all of that cash that they could just start pumping into share repurchases and they would deliver me a return. And, and if they, let's say management just used all of their cash to buy back stock, I would hate that, because I think it's a terrible idea for companies just to, forget about growing in the industry and just to repurchase stock. But if they did that, the stock price would go up so much and I would just get out because I would just make my return and I'd just get out of it, because I no longer want to be in a company with a management team that's doing that. But again, that's just another thing that they can do. They've got the potential to push the stock price up for so long that, and generate cash flow for shareholders that, I feel very confident that, it will do quite well for me. There's a couple other questions here I want to answer. If you were to invest in a company like Uber or Lyft, how long would you prefer to wait for it? Well, I'd want to see 10 years of profitability. That's the first thing. So that would be a start. I'd want to see that they have low debt as well. So some of these companies have, high debt because they're not profitable. So they have to get money from somewhere. So I'd want to see that They have 10 years of profitability. They have low debt. I like the management team, and it has to meet all the other requirements. And then at that point, I would consider one of these investments. And then, of course, the price has to be reasonable on top of that. I think you are identifying, what you're identifying is a hybrid of value and growth. Yeah, so a lot of people call that, I think someone who calls it GARP investing or something, growth at a reasonable price. So it's like kind of a combination of both. That's kind of, that's how I view value investing. But that's not the typical way that people describe value investing. People describe value as, you know, low price book, low price earnings. So, yeah, it's a little bit of a different view on value. Facebook hasn't been around for 10 years. Yeah, it has been around for 10 years. It started in 2004. So, even though there isn't 10 years, oh, sorry, yes, you corrected yourself. Yeah, so it hasn't had an IPO for 10 years, but we do have 10 years of financial statements. So, if you go to their first financial statement, whatever it was, 2011 or something, they posted their results from 2006 up until, or 2007, I think, up until 2011. So, even though they haven't been on the stock market for 10 years, we have financial data for 10 years. So that's my minimum requirement, the financial data of 10 years. And typically that means that I want the business to have been on the stock market for 10 years. And usually that's the case. If you look at my other investments, Texas Roadhouse has been around for 22 years or something, 25 years. Thor Industries has been around for like 40 years or something, 35 years. So most of the time I'm looking for businesses that have been around a long time. Facebook is just one of those businesses where I think it's so compelling that, 10 years is enough. Most businesses within the first 10 years are still not profitable. They're still just not in a good position where I feel confident about their cash flows. Whereas Facebook has been there for quite a while. They're very cash flow positive. They generate high returns on capital very consistently. And as a result, they just are one of those businesses that kind of met my requirements quite quickly. So yeah. All right. If you want to keep going, then I'll give you a second to just to make another comment if you have any further comments. I'm happy to keep going for a little while, but if there's no more comments, then I'll probably wrap it up here. But thanks everyone for asking questions, who asked questions. So we had a few people ask before I went live, and then we've had a couple of people in here live. So thanks everyone for joining us. And as always, I'll be back next week. So you can expect me back on Sunday again at 10 a.m. Australian Eastern Daylight Savings Time. And of course, the new report won't be coming out this week. It'll be the week after. So you can expect that to come out then. Yeah, I think that's just about it. Just waiting a second to see if anything comes in, but it doesn't look like there is. So it looks like I'll be wrapping this up. And if I wrap this up and I just miss your question, then I apologize because they are delayed coming in. But if I miss your question, just post it in the Facebook group and I'll make a little video answering your question. Yeah, looks like we're going to wrap it up. Thanks everyone for joining us, and I'll see you guys next week. See you later, guys.